can talk to the industrial owners and operators and get a sense for the bottlenecks they face. And they may be able to point you exactly where it is. They're like, this is the rate limiting step. This is the issue we're facing. They may not know the technology that'll solve it, but they know the broad frame. They know the cost with which they would pay for some type of solution. And so you can be proactive. And what we've done at Steel Atlas is we've gone and built a network of what we think are representative global industrial companies in everywhere from the US to Europe to the Middle East. In conjunction with those people, we can go and proactively identify these problems, develop context that other funds might not have. Because of our level of concentration and conviction, snipe the best opportunities in the space. We've done that quite effectively with Fund 1 and are really actually seeing the returns from that even in just a year and a half, which people think investing in hardware and software is going to be slow, but I can tell you that based on the data from Fund 1, it's been anything but.
Cameron, welcome to the Slice Pod, where we uncover the stories of fresh emerging managers across the early stage venture landscape. You are the co-founder of Steel Atlas, a highly concentrated seed fund investing in resilient technologies. Let's begin where we always do around here, which is by asking, how did we get to this point? Was this always the plan? Did you always know you were going to build a venture fund in this vertical specifically?
Yeah, as a young boy in Dayton, Ohio, I was absolutely certain that industrial technology was my destiny. You could have asked me in third grade and would have been a real surprising answer, but that's where I was. No, actually, I grew up in Dayton. There was no path to venture at that point. I could not even told you what that is. I couldn't even tell you what technology investing was. But I guess over time, got closer and closer to it. I went to Princeton. I studied computer science there, and obviously you start to get exposure. You hear a thing or two about entrepreneurship. I was fortunate to help start a company there, which kind of kicked off the entrepreneurial bug. And it was my intention to keep on building that and growing that after school. But life took a detour of sorts. I also played for the soccer team at Princeton and ended up having several good seasons, including leading the country in scoring, which led to me dropping out and getting drafted to play professional soccer and Major League Soccer for a number of years, which was a wonderful adventure in life and ultimately led me to my path to venture in the sense that I got to know a guy named Kevin Ryan over the years that I was playing. He helped set me up in my first outside job from soccer, which was being a back-end engineer for the league's front office while I was playing. For those that don't know Kevin, he had his first major exit in the tech ecosystem, selling DoubleClick to Google, and then started a firm called AliCorp in New York, which I think was arguably one of the top venture studios, known for companies like MongoDB and Business Insider. And after my years of playing and entirely ruining my body, blowing out a knee, breaking a leg, you have to go find a real job. So I came back to New York, and Kevin was very kind to bring me on to AliCorp when there was just a few people on his team trying to build an institution in the city. And so that was really my entry point into the ecosystem.
And what was the aha moment of going off on your own and building with your co-founder what is today Steel Atlas?
Yeah. So I was very lucky in the sense that I got to spend a number of years sitting next to Kevin, learning how he thought about building companies, investing in businesses, and I had a lot of flexibility to explore different areas. One of the areas that I got interested in was industrials, although I probably wouldn't have called it that at the time. I would have probably called it deep tech or hard tech or something along those lines. And my main theory on targeting these types of companies was simply that if I'm going to compete with all the billionaires like Kevin, I'd probably pick something that they're not focused on as much. And that seemed like a reasonable place to start. And then as the years go by, I start to become more convinced that these technologies were really structurally underinvested in. They were in many ways the heart of where venture capital started. I saw a number of tailwinds and macro factors that I thought would mean that these were important technologies to invest in for the rest of my career. I started coming to that conclusion around 2022 and was getting to know my co-founder of Steel Atlas, Talal Attia, and got the conviction that, if Kevin were in my shoes, he'd probably push to start his own thing. He was a fairly entrepreneurial guy. And as a mentor, I thought, okay, I should probably try to follow that path. And ultimately that led me on the journey of launching Steel Atlas.
Your experience as a professional athlete means that you're no stranger to competition, fierce competition. In the last couple of years, for obvious reasons that we all know, this space is becoming red hot, I would say. Lots of interest, lots of investment, lots of money pouring in from different parts of the world looking to cross borders, as well as make, sovereign supply chains more resilient in their own terms. What sets you apart at Steel Atlas, playing this game between different geographies, different verticals, industrial supply chains, and different stages of investment?
Yeah. So I'll start by, I'll ground this at a high level and giving kind of what we do, and then touch on why I think that makes us different and why we feel we're building the premier early stage industrial tech fund in the US. The thesis of the fund is straightforward. We look at the inputs to industrial outfits, and the operations of them. And we try to proactively identify areas of volatility and uncertainty. What that means is that we'll look at things like freight prices or critical mineral prices or power prices. We'll figure out structurally why certain places or companies see volatility there. Germany was a great case study when you looked at power price volatility. On the operations side, we'll look at things like machine downtime, production bottlenecks, labor shortages, or construction delays, all the things that lead to uncertainty in operating these very expensive assets globally. We'll say, what type of technologies could mitigate or eliminate these forms of uncertainty and volatility? And why we think we can do this effectively builds on a lot of the lessons I learned at Alicorp, where we would incubate companies. That's arguably the highest conviction form of investing. You're really starting something from the ground up. And we at Steel Atlas believe that you can almost do the same thing in early stage venture capital. We run a highly concentrated portfolio of seed to early A companies. We'll only invest in 12 out of Fund 2. We did 8 out of Fund 1. The reason we think we can do this is that, I don't know if you've read Elon Musk's biography by Walter Isaacson, but there's this wonderful scene in it where he describes Musk being on the Tesla manufacturing line. And he would just go and stand at the point in the manufacturing line where the bottleneck was. And he'd say, I'm not leaving this point until the problem is solved. I think this is true in more places than not in industrials. It's really different from consumer in that regard. You can talk to the industrial owners and operators and get a sense for the bottlenecks they face. And they may be able to point you exactly where it is. They're like, this is the rate limiting step. This is the issue we're facing. They may not know the technology that'll solve it, but they know the broad frame. They know the cost with which they would pay for some type of solution. And so you can be proactive. And what we've done at Steel Atlas is we've gone and built a network of what we think are representative global industrial companies in everywhere from the US to Europe to the Middle East. In conjunction with those people, we can go and proactively identify these problems, develop context that other funds might not have. And because of our level of concentration and conviction, snipe the best opportunities in the space. We've done that quite effectively with Fund 1 and are really actually seeing the returns from that even in just a year and a half, which people think investing in hardware and software is going to be slow, but I can tell you that based on the data from Fund 1, it's been anything but.
And you've built Fund 1 on the foundation of some friends and family in the steel business. How do you tap into that network of industrial knowledge base, both from an LP standpoint, but I'm assuming as well from a diligence standpoint? How does it inform your investment strategy, knowing your background in the accelerator side of things? Is it more one informs the other? They're kind of like hand in hand. Does it go both ways?
I think any relationship should be a two-way street, or at least all the good ones, because ultimately to get the best information, you need to build trust. And the information that we invest upon, it's not so much that it's proprietary information, but it's the type of information where you have to go and visit and meet with people and have relationship with folks that will actually tour you around their facilities. So that means showing up in ports, showing up in precision parts manufacturing facilities. Lucky for me, and this is part of the reason why Talal and I started to work together, is that Talal's family has been working in these areas for generations. They have relationships with top level business owners. And that means we can go around the world, visit these facilities and meet with folks. And one of my jokes is that oftentimes in venture capital, the sad part is that it's a lot like blind people describing the color blue. You can talk a lot about the wavelength. You can make it sound like you know what blue is, but there's a difference between seeing blue and knowing blue. I think that's the beauty of what we do and the relationships we've built, is that we can actually know what blue is. There may be opportunities that other investors passed on, where just because you don't have that same level of context and because you don't operate in these areas and you haven't built these high trust relationships where people are really being vulnerable. And ultimately that vulnerability is them saying like, this is what's hard. This is what's difficult. This is what's scary about running our business, is actually where we find the alpha that we invest upon. And so that's really been, I think, what's made us successful so far and what we continue to intend to do. We try to run like we're a team of two. You can't manage a million relationships. And so we would rather build a few very deep ones.
Fund 1 was $10 million, 8 checks, hyper concentrated strategy, which was one of the reasons why you really appeared on a radar. Fund 2 is going to be a little bit bigger, but you're still going to keep it to 12 checks. You're just increasing the check size, but you're still going to play as concentrated of a strategy as ever. What's the reason for that?
Yeah, so I think it is absolutely a high conviction strategy. If you can do high conviction investing, you should, because that's how you're going to generate alpha. That being said, I don't think it's appropriate to do this type of investing in every sector. There's a reason we're doing it in industrials, and it builds on both mathematical simulations, namely Monte Carlo simulations, as well as the specific dynamics we see in industrials. And I can walk you through both of those very quickly to give you the mathematical backing behind what we're doing, and then I can just talk personally about why I just believe in our investments. But when you look at industrials, deep tech, hard tech, I think that Leo at Humba has actually put together some great data sets on what returns actually look like. And what you tend to see is that industrial or deep tech returns tend to be on par with other sectors. Maybe there's less upside in certain investments, although SpaceX is a strong counterexample. But more importantly, you see that you have an incredible hit rate, a much higher hit rate in industrials for the middle. So companies exiting from between $250 to $500 million. And so when you take these two factors into account, where you have a higher hit rate at lower valuations, you still have a lot of upside, but maybe some form of a cap, then you start to redo the math on portfolio construction. And when you run the Monte Carlo simulations, if you're optimizing for a 5X fund, really what you get to is that a 12 company portfolio is pretty close to optimal in terms of how much decision-making time you get, how much time you get to spend with companies. If you tried to increase your fund size or double your probability of returning a 5X fund with these assumptions, it would require increasing our fund size to 100 companies. That's just infeasible. And trying to find that balance is that we're trying to find the place at which we can invest at appropriate pace, which we think is one per quarter, where we can do the level of diligence we want, where we can drive sufficient diversification, while actually capturing as much ownership and upside as possible. We optimize fully on this. We deploy our capital in the first check and then follow on after. We're lucky to have LPs who continue to support our companies. We think we're developing a very clear product in that regard. The reason this works in industrials and maybe not elsewhere is something I saw at Alicorp. Alicorp was incredibly successful at starting companies in the healthcare space. Why is that the case? You know all the buyers, you know all the payers, there's relatively few of them. You can track regulatory changes quite effectively. It garners a lot of institutional advantages. Consumer doesn't really have that. It's taste-making, it's kind of catching lightning in a bottle. So it's very hard to have these structural advantages. Industrial is much closer to healthcare than it is to consumer. There's very few large players in each given sector. They're highly affected by macro and geopolitical policies. You can track these and understand them and use that as a way to develop high conviction strategies and investments. We take those learnings and bundle them together, and that's what gives us the confidence to invest in such a concentrated portfolio.
Why do you decide to go up in size? Was it LP demand? Was it the performance of Fund One that gave you conviction to go bigger? Was a shift in the market overall? Why 5X the size of that fund?
The 5X side was driven more by optimal bottom-up analysis of how we should be investing. And there's a few constraints on that. Although you as LPs think about it as the product, I think about the firm as my core product and my career. And my career is like upstream of investments over the 30 to 40 year life cycle that I get. Based on the stage I invest in, I can optimally invest at one per quarter. The optimal stage for me is the seed to early A. And right now, those are $4 to $10 million rounds. That $4 to $10 million round size sort of puts a hard cap at the maximum fund size that you can run. And so that's like this $3 to $3.5 million check for us. If you say we can write $3 to $3.5 million checks into these round sizes that we're targeting, we want to run it with roughly like a standard lifetime. That means a 3-year deployment period. That puts you at 12 checks and a $50 million fund size. And we're quite locked in that this is the optimal fund size. Our target and our hard cap in our Fund 2 docs is 50 million. There's no deviation about it because that's what we believe is optimal. The only thing that would vary that over time would be based on if the market for these $4 to $10 million rounds changes. If we continue to see round sizes increase, then we'll proportionally increase our check. And the reason we've made the jump is that Fund 1 was us testing and proving the hypothesis that we could get into exceptional companies, that we could lead rounds with exceptional firms, that those companies would perform well. And the feedback we've gotten from the market is that we should have been able to take more of the rounds we preempted. We should have taken our full allocations. We left ownership on the table. The level of diligence we did at most times probably exceeded the lead investor if there was another one. And so our LPs were just like, you need to step up. It's time. Those are the factors that led to Fund 2 being the size that it is.
What's the approach to reserves? Because you had no reserves in Fund 1. So Are you keeping a little sliver of Fund 2, or are you still going to do co-invest and pass this on to LPs directly?
So we're more of the same in Fund 2. We're doing co-invest and passing it along to LPs directly. I think over time, there's a chance if we deviate from this strategy, it would be following in the footsteps of firms like Riot, where you raise committed capital that you don't pull management fees on, but have access to in order to run larger later stage SPVs. I generally think that this barbell approach is really I'm a big person on how Charlie Munger thought about the world. And if you create incentives that deviate from your core practice, you're probably going to act suboptimally. And so if we start having larger pools of capital or like a reserve pool that is larger than our primary investments, then all of a sudden our incentive will be to optimize for that versus the marginal new investment. And for Talal and I, we're very focused on our goal to be the premier early stage industrial tech fund. That means investing in the best companies at seed to early A. That's where our time and focus should be. And the structure of the fund is pointed at that goal. We think if you did reserves, if you raised large opportunity funds where you're drawing management fees, all these things pull as a distraction away from that core product. And we think that core product is the one that we're dribbling is incredibly valuable in the market. There's plenty of multi-stage firms with lots of follow-on dollars. The challenge with those is it can create different incentives between the firm and the founder. I can tell you quite definitively that once we invest in a company, we are very much like the founder's best friend. Our incentives are the founder's incentives. And we serve as someone who can be a go-between between them and ultimately the larger firms which they should raise capital from. If we had a follow-on strategy, your incentives aren't aligned until every dollar you're going to deploy into that company is deployed.
Common misconception from LPs about this approach, because it is quite different from everyone else within your bucket, within your stage, and even vertical wise. It's very much against common wisdom. Like I know, and you know, that the math actually works in your favor and not against you. But how do you handle pushback, if there is any pushback at all?
Yeah, there's 100% pushback. I also think you have to recognize that the fund product you provide is not the perfect product for everyone. Ultimately, LPs have specific goals in their strategy, right? They're running their own portfolio. And I think there's certain LPs that we're very attractive to, and I'm happy to walk them through the math on why we do it the way we do. Those are LPs that often run sophisticated fund-to-fund strategies, whether that's within their own family office or even something like Slice, where you're providing diversification across sectors. I think MIT does this well, right? When they invest in a manager, they're looking for them to stay focused on a specific strategy. And that's a great product. And then there's maybe individual high net worth individuals who may not have a massive venture portfolio, but we provide a lot of interesting insight both into early stage technology in the sectors they care about, as well as generally like market sentiment. We do a lot of analysis. We do a lot of writing. We have information rights, and our reporting is quite exceptional. And so they're getting a product that maybe is slightly riskier than the average venture fund they would invest in, but it has a lot of informational relationships to their business. I think for individuals who are investing in one venture fund, this is probably not the product for them, right? Like you should pick something that's more diversified. You should try to cover a basket of companies. And I wouldn't try to convince that person that this is the optimal vehicle, even though I'm incredibly convinced will generate best-in-class returns. They should think about their portfolio construction differently. For us, it's institutional fund of funds, and then it's groups that really like have a dedicated interest in the space. Those ultimately are the groups that tend to provide us with the bidirectional information flow that makes us better over time.
Where do you find these founders, these companies? What's the secret sauce?
Yeah, what's the secret sauce? Two things. Number one is that our secret sauce as a firm is that your goal is to build context over time, right? Like you want to have a context that other people don't have. That means you can see value that other people don't. And so that's that proactive work we're talking about. And most of that context we try to distill into essays. Unlike what's been maybe popular over the last 5 years, we don't immediately share our work publicly. Like we're not out there just trying to use our essays to generate as many followers on Twitter or whatever it may be. We definitely have the belief, and this extends to our portfolio construction strategy, that our goal is quality over quantity. We want to make sure that every time we put something out there, the 100 to 500 most important people in the areas we invest in read what we write and take it seriously. And that when that happens, they end up being the people that help source opportunities for us. The reason we get to co-invest with a firm like USB is because we've demonstrated that expertise and they see us as a valuable partner. And so when there's deals relating to the domains of interest that we invest in, we're one of the people they can go to and work with. Most of our deals have followed this cycle. We produce essays or content on a specific space. One that we recently added to the website is looking at sensor-enabled business models. In that, we specifically elucidated a growing problem in space debris. Actually, someone in your, I guess, Ophelia, in this case, received a version of this early on in some of our thinking, and she shared an opportunity from her portfolio, a company doing the first ever data-driven satellite insurance product. Because of that, we were able to preempt the seed round in this company. So another example where if we were running fund 2, we would have taken the full round. In this case, we're putting together a syndicate. This was the exact flywheel. We developed context, a specific vision on how sensors kind of reduce volatility in kind of manufacturing product processes and then other operational aspects of businesses. We found a company through our network by providing that context to people we're close to. And that's a flywheel we build over time. Founders we invest in, I think they have a few shared characteristics, but one of them is just they're exceptional communicators. We try to optimize for that, and therefore the people we work with are generally good at it too. We think that's most important, whether you're marketing, sales, recruiting. In the age of AI, where you interact in natural language with these agentic processes, being able to communicate effectively what you want and how you want it done is only going to be higher leverage. More importantly, though, I think when you look across our portfolio, we like to think that it has this water quality. And what I mean by that is, I don't know if you guys have ever watched the David Foster Wallace graduation speech at Kenyon College, but he talks about an old fish swimming by two young fish. The old fish says to the young fish, "Hey boys, how's the water?" And the two fish look at each other like, "What's the water?" The phenomenon you see in our portfolio is that because we have this context and the founder provides us with what they're doing, you often have the sensation of seeing like, oh my gosh, this was the water. There's these big obvious problems out there, and there's people taking orthogonal approaches to them. And once you hear them describe the solution, you can't unsee it. And you just have this belief that every person they tell that to is going to come to see the world the same way. And those are the type of companies we bet on, whether it's in nuclear fuel fabrication, waste management, novel solutions to creating real-time tracking in the US supply chain, or new versions of data-driven satellite insurance. It all kind of has this feeling. So that's our goal.
You have a super in-depth, like it starts with that memo, let's call it, kind of like getting yourself acquainted with that vertical, with that specific problem set. But then you do super in-depth due diligence and you write really lengthy, really detailed, highly technical memos for each investments you do. And you mentioned a minute ago that, like, you know, once your diligence was even more thorough than the lead investor in the round. Given that you only do just a handful of investments per year, how much time do you typically spend on underwriting each deal? And what does the journey looks like from the moment the startup kind of enters your field of view to the moment that you make that final decision and you pull the trigger? And it's just the two of you, right? So, like, you know, it's not that there is like an army of like associates in the backgrounds, like, you know, furiously typing away all of these like great thoughts and great ideas. Walk us through the life cycle and the day-to-day of, like, you know, doing deals at Steel Atlas.
Yeah, so I think there's two paths. One is the very proactive path, and the other is more opportunistic in the sense that you always have to be open for great founders coming across your doorstep. I think in the case where it's very proactive, it's usually almost like a 1 to 2 quarter process. If we were looking at the nuclear fuel supply chain, this is something where when Talal and I were leaving our respective firms and starting Steel Atlas, we had particular points of view on why we thought nuclear was important. We spent a couple months actually developing a thesis and a case study, in this case comparing Germany and the UAE. The quick reasoning is that Germany is the only country post-COVID that hasn't recovered to industrial levels of output to their pre-COVID levels. The main reason for that is energy price volatility. Germany was praised for a long time on their policy around wind and solar adoption, but that undercut their energy market even prior to Russia pulling out natural gas. And when you look at that and compare it to the United Arab Emirates, the UAE was arguably the country that should have adopted solar more than anyone else. It's in a desert. They're not capital constrained. They have plenty of room to put as many solar panels as they want. And in fact, they invested in it. If you look at the country today, 25% of their power is from nuclear. It'll be 75% in the next 30 years. They're one of the few where per capita consumption of fossil fuels is going down, despite being a major oil producer. They're going to be one of the most attractive places to put data centers. And so we looked at these two markets and we started asking the question, what would it take to get a country like Germany to reverse its policies? What are the set of problems nuclear would need to solve to make that happen? And there was 3 big factors for us. One was you needed to be able to provide your own fuel. Countries like Germany and the US could not be buying enriched uranium from Russia, which they still do. Number 2 is that they needed to figure out how to manage waste. In the US, that's like a hundreds of billions of dollars liability that we've already created, and it'll only be exacerbated as we continue to deploy the nuclear fleet. Number 3 is ultimately you need to figure out how to make non-proliferant nuclear reactors. If nuclear is going to be global, we're not going to let what happened to India happen around the world, where we give them energy technology and they come out with a bomb. That's just not a safe place that we all want to live in. And so we spent time developing this macro view. And it didn't necessarily give us the specific insights on the technology we needed to invest in, but we had the framework for what needed to happen. Then we started sharing that. We started meeting with companies. And it was through this process over several months that we ended up identifying Transmutex as a potential option as an investment. And then you meet the company and enter what we think is a 1 to 2 month diligence period where you're doing all the standard VC diligence, maybe for us, like a little bit more extreme than your average seeds fund, but that's doing the technical deep dives, that's going and putting them in front of customers. So people that would be buyers of power using their waste management techniques. We take that customer diligence phase very seriously. It's what we did at AliCorp to decide if we would incubate a company. And it's what we're uniquely able to do given the network that I think kudos to Talal for building. When we get to that point, we're upfront with the founder. We usually are early to commit. We don't require anyone else's signal or investment in the round. As soon as we're done writing the memo, we make that memo available to the founder. We think this, we're proud of this. We think there's nothing proprietary. We've made our decision at this point. Use this to raise your round. I mean, I can tell you, I don't know if I can tell you the specific case study, but one of our memos, we had 50 outside investors request access to that memo, and I think use it as a core part of their diligence in making a decision. And in this case, we were not the lead investor in the round. But I think that's the quality we're trying to produce. In the optimal case, that's the life cycle of an investment. And that's why we invest at one per quarter. You can't be just shooting from the hip if this is really the style of investing you want to do. Yeah, and one of the lessons I learned at Alicorp and from Kevin was great opportunities keep on coming. Don't feel anxious to deploy. Like life is long, like they're going to keep on happening. And so you want to develop a strategy that can be sustainable and produces a durable advantage over time.
With such a highly concentrated portfolio, you have the ability to run deep due diligence, but you also have the ability to really engage with the founders post-investment and spend a lot of time with each and every one of them and be the value-add investor that every venture capitalist promises to be. What areas do you find yourself being the most helpful once you do pull the trigger on writing a check?
I think there's two ways you can be useful. One way, and I think the most tangible way, is you have a network. That network has some relationships that are hopefully proprietary, high trust, and you can use those relationships to produce some valuable outcome, a partnership, customer contract, or whatever it may be. And this is usually something that's sufficiently obvious at the moment of investing. This is something that Talal does exceptionally well. My joke is that the fun game with Talal is give him a person on LinkedIn and give him the challenge of seeing if he can set up a meeting in 3 weeks. And the answer is he probably will succeed. It's just what he's uniquely good at. I'm uniquely horrible at that, but that's why we're a team. And we can produce that value quickly. And long term, though, it's even simpler than that. When you're in the investor seat, you're like the real estate agent. I look at homes all the time. I see the market as a whole. I have information. I have relationships. And so the relationship with the founder is like with our LPs. Is if we have fewer relationships than most firms, I can be closer with our founders than most firms. That means I can be vulnerable. I can build trust. And ultimately, I think if you talk to our founders, we're just a person they feel close enough with to reveal their problems, the challenges they're facing. Once again, this goes back to the incentives. Once we've deployed the capital, we're on your side, we're in your camp. That creates a different relationship than what you might see at a multi-stage firm. We lean into that. We just try to be close. You try to be human. Ultimately, this is a game of information. And if you don't have the information flows, then you can't make optimal decisions. And so we try to be there for our founders personally and professionally. And we think that'll sustain us over time. Ultimately, it's build relationships with people and be supportive like a friend. Like that's all you really can do.
Be a partner. You had an in-between stage between going from professional athlete to venture investor. There is a difference being part of a team and an infrastructure with an amazing track record, established processes, great deal flow, wonderful ideas, surrounded by really smart people, and doing it all on your own. What were the hardest things that you personally faced transitioning from your prior role into this sort of like new domain of being an emerging manager?
Yeah, it's both the blessing and the curse of having worked in great places with great people. What makes them so great is that you're surrounded by people who are teaching you what excellent looks like every day. You have people pushing you. Kevin is the epitome of this. I don't think there's any New York City entrepreneur who started more unicorn companies. When you spend time next to him and the team he built, it refines how you think. There's arguably an infinite progression to that point, to whatever Kevin's level is and the people around him. I think that's something you inevitably miss and you have to recreate, right? When you're stepping out of this known infrastructure, you need to make sure you still surround yourself with people that are sharpening your thinking, pushing you, and refining how you perceive the world. It's only in these high trust relationships where you get challenged on your thinking. It's too easy when you walk into a conversation with friends or for a quick coffee for you to share an idea and people go, oh, that's very interesting. Let me ask you a friendly question. It's much less likely that person is going to go, Cam, I am not going to waste $1 on that idea. And to give you real serious feedback because we're friendly for the most part. And so you need to make sure that you've cultivated a network that's going to push you and refine you, that you've joined in teammates that are going to do that. Because that's ultimately the thing that can get lost is that if you're not around excellence all the time, then you may not remain at that level. This is what I saw with great teams when I was playing professional sports. Part of the reason why Barcelona is so good, why Man U was so good when I was a kid, is that there's just exceptional players all around you. Malcolm Gladwell talked about this in Outliers. Like part of what leads to outlier outcomes is just people competing against themselves and pulling themselves up. I know when I grew up, like I was in a small school with a small town. I think we had 18 boys in my class where we graduated. We shouldn't have had any exceptional soccer players, but it turned out that there was a goalie, Stephen Cleveland, and myself, who were both really dedicated to the sport. And so we'd train and play soccer every day against each other. We ended up doing exceptionally well. I went to Princeton. I played forward there. He went to Dartmouth. He played goalie there. I got drafted to Montreal, and he got drafted into Major League Soccer as well. From a school that had zero professional athletes, to have two come out who knew each other and played together isn't an anomaly. It's just the nature of working in competitive systems. For me, that was the most important thing to figure out how to recreate. It's very easy to get isolated and sit in your apartment in New York and not get hard feedback. You need to put yourself in the positions to receive it. And so that's what I think I'd push people to do if they were starting a fund, is to recreate those things.
How do you do that?
There's a few groups that I'm a part of that one curates other emerging managers. I actually was just in Jackson Hole with a group of about 40 of them. You spend time together. You're able to pressure test ideas. You're able to do it in a way that's non-public. And you're able to get that feedback and hopefully build like trusting relationships with individuals at the same place in the journey. The other thing is going outside of the venture capital ecosystem. There's groups like Dialogue and other ones that bring together business leaders, like artists, politicians, and they give you forums where you can unabashedly share ideas and get pushback on everything from your views on politics to particular technologies. These behind closed doors situations are places you can seek out. And this is why being in a place like New York City or San Francisco or LA, I think is so important, is because that's the stuff that you get by being in these hyper networked areas, is that you can find these groups and make them a part of your life. I highly recommend that to ensure you're getting a diversity of thought, which is hard to do if you hang out with your 5 favorite friends in the echo chamber.
For real. How do you guys run the firm? There's two of you, there's a lot of ducks to keep in a row, even though you may not do that many checks over the course of a year, but there's LPs, founders, introductions, everything. I know Talal has his trusty little notebook where he writes his entire life on it. What's the stack for the modern manager and for a highly concentrated bet like your kind of firm?
Yeah. Superhuman's great. We really like that at Steel Atlas. No, I think it starts with, number one, it starts with the team you build. Even though we're a team of 2, it's still a team. You want to get energy in different places, or else it's going to be very hard to get things done. For Talal and I, we make it a monthly practice where we sit down, and the focus of this monthly alignment session is to surface these areas that give each of us energy and drain each of us. We want to make sure that we're like leaning into the things that are going to lift each other up, because that's how we're going to have longevity, and making sure that when we're asking a lot of each other, it's clear. The lucky part for Talal and I think people should look for in their partnerships, is that we joke in everything Talal and I do, one of us is the aisle seat and one of us is the window seat. We're a bit like yin and yang. For Talal, he's naturally externally oriented. I think the joke about LinkedIn is like very true. There's a lot of facets of the firm that benefit from being proactive about managing relationships. LPs is a great example of that. Ongoing portfolio relationships, making sure that we're constantly creating and building the surface area that we touch and keeping those things warm. That's where Talal thrives. And because of that, he creates lots of opportunity inbound. On the flip side, like my natural disposition, if we're diligencing something, for example, Talal's like going to go find the world expert to talk to about the problem. I'm going to bet that I can become the world expert, which I can't do, but like put my headphones on and I'm going to try and figure it out. And these two complementary approaches fit very well into how you operate a firm. So Talal is making sure that we're getting all the external things done. I'm making sure that we drive everything through the finish line. I'm sitting in front of my computer, whether it's making sure the admin work gets done, whether it's making sure that we're staying on top of the diligence process with a company, so on and so forth. You really need to make sure that you're both not trying to do the same thing all the time. This is another lesson from Kevin. If you're always showing up in the same meetings every day with some person, it means the organization is failing, because the organization has no leverage. And so you need to be thinking about how you build a firm that has leverage, even if it's just a team of 2. And we've tried to continue to build upon that. Obviously, AI is helping a lot. We really like Lindy AI. It's a product that lets you build out your own kind of agentic workflows. We've used it to automatically ingest and generate quarterly reports. We use it to draft and create outbound emails for LPs we haven't spoken to in weeks, or founders we're tracking. So all this stuff starts to kind of lubricate. We get to focus on where we think our decision-making is most important, which is developing new ideas, proactively finding those companies, underwriting them effectively, and then being there for our founders when we need to.
How do people get in touch with you? If the 100 people list that you have, like what's the best way to build a relationship, either as a prospective LP or as a founder looking to get a check from you guys?
Yeah, you can find me across all the socials. Probably Twitter and LinkedIn are the most active, but I'm Cam39Porter. That's my handle. Goes back to the days of being a soccer player. 39 was my number. So that's stuck with me and I think will be with me for life. You should be able to find me there. I'm guessing you can guess my email at steelatlas.vc. If you can't, you probably don't deserve to be in touch with us.
And this is kind of like a signature question that we ask towards the end of the sort of like the beginning of the conversation, right? What is the one thing that you had prepared to talk about today that we did not ask you, that you're going to walk away from this recording and be like, dang, I had this shot of 100 people to hear this one kernel of an idea, and Fabric didn't ask me, and I didn't have the opportunity to share?
Yeah, I think one idea that I would want to leave people with, and it was the biggest question mark with our first fund. We were immediately warehousing and investing in deals like in nuclear. And we get pushback. Like the biggest question mark we got is like, are you building a venture portfolio? Like, can you build venture investments in industrials? I can tell you unequivocally the answer is yes. It's always important to go a layer deeper and understanding the dynamics and the capital stacks that go into companies, even in the nuclear space, for example. A lot of these nuclear companies and hardware companies actually follow the canonical archetype of what a good venture investment is. And I'm going to abstract away technology. What makes a good venture investment is pretty simple. It's a company that takes X million of dollars up front. It uses that to build a durable advantage and produce a revenue stream that has high and defensible margins over time. And it doesn't really matter whether it's hardware or software that does it. You just need to find businesses that have that structure. For example, our nuclear companies spend hundreds of millions of dollars designing a reactor, but they then license these reactors to operators. Those licensing fees are 5 to 10% upfront, and then 1% per year for the operational lifetime of the reactor. And I can tell you definitively, these revenue streams look very much like software. Westinghouse is a great example that Brookfield has done exactly this with. The nuclear companies will all look like this. They'll also probably return on a faster time horizon than most software investments, because once they get to the point where they're in the licensing process, it makes sense for them to go public, to have project vehicles that access financing. And so we would expect our nuclear companies, despite all the pushback, to go public much faster than our software companies and provide liquidity. And the same is true on the software side. We don't invest in companies where you're kind of betting on the ability of someone to just navigate an idea maze. We invest if people have a clear plan to build a durable like moat via some upfront investment and capture value over time. Genlogs is a great example. They've built a proprietary sensor network with millions of dollars across the US highway system that they're now monetizing at 85% gross margins and growing incredibly fast. And so we find businesses that fit the classical archetype of venture capital, software or hardware, and we expect those to return in ways that are great. But I think to get lost on the software or hardware part in industrials is a huge mistake. That means people will miss a lot of great investments.
What is the future of Steel Atlas? Like, what happens after this fund to $50 million fund? Is there another 50 right around the corner? Is it going to be like a franchise of $50 million funds of 10 to 20 investments each? When you talk about building the firm, what is the makeup of that firm? What does it look like once it reaches scale?
Yeah, I think the way we think about it is we want to build pointy arrows. The point of that arrow is this premium investment strategy focused on quality over quantity, one deal per quarter. It starts in industrials. And we believe that creates downstream opportunities naturally. For example, we've talked about having an opportunity fund that doesn't have management fees. One thing we've set up the relationships for is that in 3 to 4 years that some of our companies are building very large infrastructure projects. There's a few that are on the way. And there's no reason as board members in that company, we shouldn't have the capacity to put hundreds of millions of dollars to work in these projects. It turns out that, for example, a nuclear reactor that runs for 60 years and produces cash flows at a 20 to 30% IRR is a pretty nice complement to a venture portfolio as a whole. And if you have an inside track on underwriting that, you should probably take advantage of it. So that's one way that we think about the firm growing over time, but it's always with the point of the firm being this premium early stage strategy. Number two is that I think this thinking and thought process that hopefully we've laid out pretty well here actually extends to other categories. Healthcare and biotech is another one. I think there's no reason why we couldn't see bringing on a GP to launch a new vertical under Steel Atlas with these core principles at its heart. And if I'm totally frank, there's people we know who are running successful biotech companies where that might be something in the future, but just focus on another vertical where we think the dynamics are very similar.
Breaking my brain because I have huge respect and love the model. And at the same time, with some who's often talk about kind of like how we want managers to be sub $20 million, because you get into the nooks and crannies where the multi-stage firms cannot reach and where there is very limited competition. However, you've talked about today, it's equally differentiated and very niche, where you don't seem to suffer a lot of competition, rather than that typical 20 to 30 portfolio construction, spray and pray, and let's hope you find a good one. You're going in and be like, no, I want every single one of these investments to be a viable business that not just gets to an outcome, but generates value for its customers and all of its stakeholders. Why you say the rules are meant to be broken, because in this specific example, we really need to break our own rule. I feel like we do have to recommend this product. I love it. I love the strategy. I love the focus. I love the thoughtfulness. Have you been able to articulate the entire kind of like all the principles behind what you guys are building? I had the opportunity to spend time with you guys in person with Talal as well. And yes, you're very complimentary in the way that your personalities run.
I will tell you, just go back to the energy thing. Like, one, thank you for the kind words. Like, it's very, like, truly means a lot for you to say this. I know you guys talk to a lot of people, and Talal and I have tried to put a lot of thought into it. And part of a goal is like set a high bar for ourselves and then hope you meet it every day. But I mean, on that, it's like, Talal is incredibly outgoing. If you put him into a room of 100 people, he will meet all 100 people.
We've seen that in action. I love your strategy, and I think this is going to pay really good dividends. I 100% agree on the barbell approach of like having a flagship product that it's constrained in focus and size, and then giving opportunities to scale the footprint of the firm in different, more creative ways. Ultimately, what we talk about all the time is that best companies will stay private forever. And so there is many different ways in which you can give LPs a shot at participating in appreciation and distributions that are not necessarily the typical unicorn factory of, investing the pre-seed, exit at IPO, sort of like merry-go-round. So I do think that you'll be rewarded.
One thing I'll add with that I think is worth calling out, because it's a big question in the venture community, is if companies are staying private for so long, how are these early stage funds going to get returns? Part of the reason why we do first check only. One of the long-term patterns we're seeing is if these companies are going to stay private forever, we actually talk to people who run some of these larger vehicles. I will tell you, a lot of them underwrite to owning 30% of their best companies, which is a massive number to get to with primaries. When we think about our construction as a portfolio, it's also thinking about our strategy. It's also thinking about how we fit into the ecosystem as a whole. If we're a first check only fund that can hold a position for 5 years and have relationships with later stage funds, I think we're going to see more high quality companies doing tender offers, and those tender offers will extend to the people that are early investors.
100%.
And therefore, yeah, exactly. Therefore, we're going to be in a position where we don't have to think about putting in company capital while pulling it out. Rather, we can just be a seller, hold for 7 years. That company can stay private for another 7, 10. We don't care. But we do that 100%. First life cycle and someone else takes it all.
Yeah, we've seen it all the time. And within the last fintech mega cycle, Stripe, Sequoia, spinning up a new vehicle to buy out the early vehicle. Ramp just did a massive secondary. This is mostly institutionals buying in and buying down the cap table to fortify their holdings. SpaceX, all the mask economy sort of companies do this on a daily basis. There is a thriving marketplace. And I think that the incentives of going public have greatly diminished over time. I think that there was a dire need to be able to go public in order to access a larger pool of capital, debt from the public markets as well. We've seen a phenomenal rise in private credit over the last 5 to 10 years, fastest growing asset class across the entire financial landscape. And not just that, liquidity for early employees, early investors can be found in what are now becoming the Thrives and the Heritage and the GV of this world. Just needed to buy more. And you're not just going to do it through a primary round. It's going to be very hard to get to that 30% target just underwriting a Series A. Good luck with that. But yeah, this is awesome. Thank you so much for being here. Really enjoyed it. You two are great. I'm so glad you were able to share in such a thoughtful and compelling way what you guys are building.
Well, thank you for the thoughtful conversation.
You've just listened to another episode of Slice Season 2. If you enjoyed this episode with Cameron, make sure to subscribe to our Substack not to miss future episodes. And we'll see you then. Bye.